Welcome back to The Explainer. If you follow the gaming space, you already know that tectonic plates shifted massively this year. We're diving deep into the unprecedented 2026 gaming hardware crash, using some definitive intelligence from tech analysis to figure out exactly why gamers flat-out rejected premium console pricing, looking at everything from semiconductor inflation to basic behavioral economics. Let's get into it.
Here's our roadmap for today. We'll kick things off with that historic sales crash, break down the actual anatomy of a $900 console, look at the true cost of ownership, check out who actually won this year, and finally wrap up with Sony's holiday exit strategies.
All right, part one, the historic console sales crash. Let's get right into the primary symptom of this whole market anomaly.
Minus 58%. Let that sink in. We saw a staggering 58% year-over-year contraction in 9th-generation console sales. And hey, this isn't just anecdotal. August 2026 telemetry from Circana and GSD confirmed the market essentially slammed on the brakes. Launch month sell-through plummeted 42% below their internal projections. Absolutely brutal.
David Cole over at DFC Intelligence really hit the nail on the head here. He pointed out that trying to position a mid-generation console as a $900 luxury commodity is just, well, a severe miscalculation. Historically, consoles get cheaper over time. Defying that gravity, huge misread of consumer tolerance.
Which brings us to part two, the anatomy of a $900 console. How on earth did the cost of these premium boxes get driven into the stratosphere?
To really get this, we have to talk about the bill of materials, or the BOM. Just as a quick refresher, this is the baseline manufacturing cost. Literally everything from the bare silicon wafers down to the plastic shell. Getting a grip on the BOM is absolutely crucial to understanding why the market revolted.
When you look at the breakdown, it paints a pretty clear picture of luxury hubris. Despite a super high $685 production cost, Sony still demanded a massive margin of nearly $215 on the PS5 Pro to hit that $899 MSRP. Now compare that to the Switch 2 or the Steam Deck OLED. Both of those are sitting in the $300 to $380 BOM range, retailing for around $500 to $550, and guess what? They're seeing explosive mass market success.
So why was the PlayStation BOM so high to begin with? Well, these exploding manufacturing costs were mostly driven by intense competition from the AI sector. You've got hyperscale AI data centers aggressively fighting for TSMC's advanced silicon wafers. Combine that massive silicon squeeze with a 40% spike in GDDR7 high-speed memory pricing, and yeah, base costs are going to skyrocket. But, the ultimate trigger was really corporate hubris. The sheer determination to preserve premium hardware profit margins rather than absorb the cost to build the install base.
But hey, the initial sticker shock is only half the story, right? Let's move to part three, the total cost of ownership. At $899, Sony completely breached consumer price elasticity. Gamers looked at those minor frame rate bumps, the AI upscaling, and pretty overwhelmingly decided it simply didn't justify a near four-figure entry barrier. The perceived value just wasn't there to make us stretch our wallets. When you actually map out the comparative first-year total cost of ownership, the contrast is kind of mind-blowing. A complete PS5 Pro setup rockets to over $1,200. Compare that to the Xbox Series X at about $1,039, or the Switch 2 down at just $549. Honestly, you could practically build a custom mid-range PC for less than the cost of the PlayStation ecosystem. Because that illusion of an $899 console shatters the second you actually try to play the thing. Oh, you want a disk drive? That's an extra $120. Want the privilege of standing your console vertically? That'll be a $30 piece of plastic. Add in an annual online subscription and, let's say, just 2 games, and suddenly your $899 box is a $1,340 investment. The market pushback to this nickel and diming for basic essentials was fierce, and it was immediate.
Let's pivot to part four, the triumph of open alternatives. Because while premium home consoles were crashing hard, other sectors were absolutely thriving.
We are really looking at a tale of two entirely different philosophies here. On one hand, you have the mass-market, consumer-friendly approach of Nintendo and Valve, accessible pricing, free multiplayer, and full backward compatibility. Then, on the other hand, you have a lockdown luxury strategy with high entry barriers and mandatory network fees. It's pretty obvious which one consumers decided to reward.
Ultimately, what we're seeing from the Tekken report is that massive first-party catalogs, total user freedom, and seamless portability are straight up defeating closed digital storefronts and expensive, stationary teraflops. I mean, the Switch 2 achieved the fastest sell-through in corporate history. Meanwhile, open handhelds like the Steam Deck scooped up millions of cost-conscious gamers who are leveraging free PC networks and those steep seasonal Steam sales.
Which brings us to the aftermath, and Part 5, Sony's holiday exit strategies. With the critical fourth-quarter window coming up fast, how do they even begin to recover their footing?
According to predictive financial modeling from Tekken, Sony must urgently execute one of 3 distinct strategic pathways to rescue their holiday performance. Pathway 1. Retain that $899 price, but heavily bundle in essentials. Give us the disc drive, the stand, and PS Plus for free. Pathway 2. Take a hardware loss and permanently reposition by slashing the MSRP to $749.99. Or Pathway 3, accelerate the first-party pipeline and fast-track major exclusives like the next Naughty Dog titles to visibly justify that hardware leap.
Looking at the evaluation matrix, the actionable financial reality is pretty clear. Taking a short-term hit really is the optimal route here. Absorbing a $50 loss per unit to permanently drop the price down to $749 yields an incredible 95% sales recovery probability. It guarantees hardware sell-through, which ultimately protects their digital storefront in the long run. Maintaining the status quo? Yeah, that offers a dismal 10% chance of recovery.
Synthesizing all these industry lessons from the Tekken editorial board, the writing is totally on the wall. They're strongly advising consumers to hold on to their cash, defer those PS5 Pro purchases until the market enforces strict price discipline. PC enthusiasts, you're better off prioritizing mid-range graphics card upgrades like the RTX 5060. Families should definitely point toward the economical Switch 2. But most importantly, this is a massive wake-up call to publishers and manufacturers. Restricting games to overpriced, luxury hardware just creates commercial bottlenecks. Balancing raw compute power with accessible pricing is the ultimate law of console longevity.
The era of taking consumer loyalty for granted is officially over. Modern gamers demand tangible, generational leaps and fair hardware monetization before they even think about dropping four-figure sums. That 58% sales slump wasn't just a blip. It was an unmistakable message. So I'll leave you with this provocative question to think about. Will long-term industry leadership return to the companies that actually honor consumer economic realities? Thanks for joining me for this explainer, everyone. I really hope this deep dive equips you with the objective data you need as you evaluate your next big hardware upgrade.